Today in this session, we will be learning about shareholders value, which consists of economic value added and value at risk. Then we have is venture capital financing. We will start with shareholders value. So what exactly is shareholders value? From investor perspective, value created is commonly measured as the growth in the company's share price over a period together with the dividend receipt from it, which means the total shareholders return. But share price react to other factors outside the control of the management in the short term. For example, rising of interest rates. So there is a disconnect in the view of value created when it comes to investor perspective. From management perspective, the insight offered by the value focus is that the use of equity capital is not free. The equity is invested in an expectation of an earning return, and this required return defines the company's cost of capital. Management can only create value for shareholders if the company consistently over the long term generates a return on capital which is greater than the cost of capital. So how does the management create the shareholders value? Management had two principles to create shareholders value. First, to obtain greater efficiency in either margin or in the asset. This is often referred to as numerator management or denominator management. Numerator management is about improving the margin or achieving sales growth from existing capital base. Denominator management is all about asset and cost efficiency. So basically, company goes for either managing their sales to profit margin or managing their asset in order to reduce cost, basically means gaining cost efficiency. Then the second way is by the growth. And the growth can be achieved by investing in projects which are expected to generate a return in excess of the cost of capital. That is basically the investment decision. So now we will try to understand what is economic value added. EVA is basically defined as the difference between firm's profit and cost of all capital employed, that is weighted average cost of capital. This measure is not directly given in the income statement, so we can derive this value by the formula return on capital minus cost of capital multiplied with capital investment in the project. So there is another thing, that why EVA reflects value creation and why not the net profit or accounting profit in income statement is considered as value creation measure. We do not consider the net profit available for equity shareholder as a measure of value creation. It is because EVA measures the value created above the required return for shareholders of the company. But net profit doesn't consider the cost of equity shareholders and cost of retained earnings and other elements. So the formula for economic value added is return on capital minus cost of capital multiplied with capital invested in a project. So the first variable, return on capital, can be calculated by operating income after tax divided by total capital invested. So operating income means EBIT, and that is earning before paying interest. And we need is operating income after tax. So from EBIT we deduct the taxes. The next what we have is capital invested. Total capital invested can be calculated by adding the book value of equity with the book value of debt. From that we can calculate the return on capital. Then we have to calculate is cost of capital. And cost of capital is basically the weighted average cost of capital, which we learnt earlier. So that's all we need, the three variables: return on capital, cost of capital, and capital invested. We'll see an example to understand the economic value added concept. Here we will try to calculate the EVA of Nestle in 1995. First we need to calculate is return on capital. So for that we need is after tax operating income divided by the capital invested. So here after tax operating income is 3,767 million divided by investment capital of 29,500. So we got is 12.77 of return on capital. The second variable which we require is cost of capital. So for that they have given cost of equity of 10%, cost of debt of 3.16%, and they have given a debt to capital ratio which is 11,726 divided by 68,376. So the debt is 11,226 million and equity is 68,376 million. So from that we can input in the formula of weighted average cost of capital, which we have learnt earlier. So 10% is the cost of equity multiplied with the proportion of equity, that is 56,650, which we got from subtracting the debt from the total capital, Then we have divided that with the total capital. So that is the weight of the equity plus costs of debt multiplied with the weight of debt. So we got the weighted average cost of capital as 8.85. So with this we have all three variables. So return on capital minus cost of capital multiplied with the total invested capital. So we got is 1154.50 million. So this value is the economic value which has been created by this firm. There are certain drawbacks of EVA for companies, divisions or projects which make significant infrastructure investment with a long gestation period. The current EVA may not be a good indicator of quality of investment. Let's take an example of a growing startup company. Tsingtao is a Chinese beer manufacturing company which has made a significant capital investment in last 2 years and plans to increase its export over time. So they have given the return on capital as 1.28% and cost of capital as 15.51 and capital invested is 3015 million. So with that we can calculate the value added, which is coming in the negative figure, which is minus 429 million. It is because the return on capital is much lesser than the cost of capital. So it is obvious that the economic value added will be negative. So this is a disadvantage of economic value added. It does not indicate the proper value added figure for the startup firms which has a higher capital expenditure in their book. So Tsingtao had a negative EVA of minus 429 million in 1996. So we can come into a conclusion that whether the firm has invested in poor projects, or the firm has an inferior management, or the firm is currently earning less on its projects than it should be earning given its cost of capital. With given information, we cannot comment on the first two things. We can definitely say that they are not earning enough from their projects to meet their cost of capital. So what does the current EVA of young startup firms early in life cycle indicate? It indicates that the measure of EVA will be negative. The next topic we have is value at risk. So for every investor who have invested or is considering investing in a risky asset at some point in time, will have a question that how much he can lose on his investment. So for that, the value at risk provides the answer. In its most general form, the value at risk measures the potential loss in value of risky asset or portfolio over a defined period for a given confidence level. It is made of a statistical measure which uses probability distribution in order to come up with a value. There are three key elements of value at risk. First is a specified level of loss in value. Second is a fixed time period over which the risk is assessed. And third is a confidence interval. The value at risk can be specified for an individual asset, a portfolio of asset, or for an entire firm. The measure is sometimes defined more narrowly as a possible loss in value from normal market risk as opposed to all risk. So in the industry, what is the use of value at risk? The value at risk can be used by any entity to measure its risk exposure, though it is used most often by commercial and investment banks to capture the potential loss in value of their traded portfolios from adverse market movements over a specified period. This can then be compared to their available capital and cash reserve to ensure that the losses can be covered without putting the firm at risk. The computation is much statistical, so you won't be learning the computation part for now. The next is venture capital financing. Venture capital is a form of financing that provides fund to early stage emerging companies with high growth potential in exchange for equity or an ownership stake. So basically, venture capitalists take risk of investing in startup companies. The idea is to invest in a company's balance sheet and infrastructure until it reaches a sufficient size and credibility so that it can be sold to a corporation or so that the institutional public equity market can step in and provide liquidity. In essence, the venture capitalists buy a stake in entrepreneur's idea, nurtures it for a short time period, and then exits with the help of investment banker. Venture capital's niche exists because of structure and rules of capital market. Someone with an idea or new technology often has no other institutional to turn to. Laws related to bank limit the interest the bank can charge on loans, and the risk inherent in the startup usually justify higher rates than allowed by the law. So the bankers will only finance a new business to the extent that there are hard assets against which to secure the debt. And in today's information based economy, many startups have few hard assets. So venture capital fills the void between source of funds for innovation and traditional lower cost of source of finance available to ongoing concern. In order to attract private equity funds, the venture capital industry needs to provide sufficient return on capital to the participant. Simply, the challenge is to earn a consistent superior return on investment in inherently risky business ventures. Theoretically, there are certain features of venture capital. First one is high degree of risk. Investing in startup or idea is always risky, and higher risk yields higher return too. So that's what is the motivating factor for a venture capital participant to put the money into their new innovative projects. Second one is equity participation. Venture capital are basically equity participants or potential equity participants who await for the moment that the company carries the growth, then becomes profitable so that they can make the capital gain by selling the shares. It is obvious that the venture capital is a long-term investment. It generally takes a long period to encash the investment in a security made by the venture capitalist. And the fourth one is participation in management. Yes, in addition to the providing capital, venture capital funds take an active interest in management of the assisted firm. Thus, the approach of venture capital firm is different from the traditional lender or banker who doesn't interfere in the management of the company. Achieve social objectives. Venture capital projects generate employment and balance regional growth indirectly due to setting up of successful new business, though these are different from the developmental capital provided by the government. The last one is investment is liquid. A venture capital is not subject to repayment on demand as with the overdraft or the following a loan repayment schedule. The investment is realized only when the company is sold or achieves a stock market listing. It is lost when the company goes into liquidation. The last thing which I want to talk about is how the timing of venture capital is important. More than 80% of the money invested by venture capitalists goes into adolescent phase of the company's life cycle. In this period of accelerated growth, the financials of both eventual winners and losers look strikingly similar, meaning that the company which is going to hold on to its growth in sales streak and the company which is doesn't will look similar in this stage where the investment is infused in the company. Thus, the critical challenge for the venture capitalists is to identify competent management that can execute the supply of growing demand.